Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 21st, 2016. I'm starting this video in pre-market. It's a little after 9 o'clock Eastern Time. After going over the charts, there's really not a lot of much new to report, and what I wanted to do is just touch on a couple of the things that I'm looking at. I think we're still at a pretty critical juncture. I don't think there's any argument there where the markets are. I know some bulls have declared victory, some bears have thrown in the towel, some haven't. Bull bear, I don't really, you know, try to box everybody or anybody into that category. As you guys know myself, I'm bullish and bearish. And one of the main things I want to talk on this video, if there's time towards the end, is really, I do a lot of market analysis. That's what we do as traders and investors. We need to get an idea on where the broad market's going in order to align our trades most successfully, in other words, on the long or short side. But, at the end of the day, trading the broad markets can be very frustrating and futile, especially at this point in time. Something I've harped on for the last few weeks has been, the fact that I'm seeing quite a few and continue to see quite a few very bullish charts and sectors. I'm talking about looking at different sectors within the market and some very bearish charts. And that's not been the case in the last few years. Overall, especially, for most, not the entire run of the bull market from the 2009 lows up to the highs last year. For the most part, just about all sectors, all boats and ships were being lifted with the rising tide, I think is how the expression goes. And sometimes all ships fall with a falling tide, such as 2008 during the financial meltdown. The good, the bad, the ugly, they all got sold. Gold went down. Just about every sector out there went down. That was a deleveraging process, an unwinding of excessive margin and other things. But that's not been the case so far, and I've pointed that out. And that I just wanted to harp on that because I can't impress that fact enough that trading the market is not only going to be frustrating and as long as this continues, it's just not going to be very profitable. And what I mean by that is when I say the market, the S&P 500 is probably the most commonly referred to index. The media talks a lot about the Dow. The Dow, you won't see analysis from me on the Dow. The Dow is 30 stocks. It's not a diversified index. The S&P, although it is large caps, it does have a pretty good sector representation. So you have, like I said, energy stocks, for example, which I've been very bullish on throughout the year and had quite a few, successful trades on the stock. Anything energy related, not just gas or oil, but solar stocks and some other things that have moved up as well. And of course, you have the commodities and miners and industrial metals. We had quite a few successful trades there, and those charts still look longer term bullish. So you have that mixed bag, and that's all I wanted to point out. That don't get overly focused on trying to trade the market, because if you're trying to trade, SPY, QQQ, particular the SPY, you're trading the good with the bad. And it's very possible this market just slogs around all year, but there is tremendous money to be made within individual sectors. So enough on that. Let's just dive into the charts and take a look here. This is a US dollar weekly chart. I know there's been quite a few posts and good stuff put up in the trading room lately. Thanks, guys. I haven't really commented much on the dollar lately, but my analysis has been consistent you can go back for months now. The dollar is up here in pretty much in this trading range. You can see by these two white lines. I'll zoom down to the daily chart in a second. There are some other developments. But until we break out of that trading range, trying to call the direction of the dollar is pretty futile. Now, I've made my case, a pretty clear case, that I believe that we'll have a downside break from this range. But until we do, it is a trading range, and you have to recognize it as such. And so the dollar's likely to grind around. And it's a fairly relatively wide trading range for the dollar. You can see it there from about 93 all the way up to, about 10, just over 100. Yeah, right around 150. So that's the DXY. And I mentioned before that, going back at least for a decade here, that's as far back as I can go on this chart. Anytime you've seen the dollar reach overbought levels and RSI above 30 on the weekly chart, that has been followed by these major corrections in the dollar. They're circled here: overbought, overbought, overbought. So far, this one has only resulted in some sideways action, and that has alleviated the overbought conditions, but you still can't rule out another move down. And again, you can try to guess it all day long. The divergences do indicate to me that this trend has really run its course, and we may have an impending trend change. In other words, when the dollar peaked here, made a slightly higher high at this point, versus the PPO and the RSI making considerably lower highs. In other words, strong negative divergence at those highs. And so far, since that second high, you can look at the impulsive move down, pretty impulsive move down the dollar. And where that's important is for dollar-sensitive assets such as gold, oil, and certain dollar-sensitive commodities, as well as certain sectors of the economy that may be impacted by a falling or rising dollar. This would be our likely first target if the range was broken. We have these highs back here, and I believe there's some to the left of the chart. And ultimately, if we go out longer term, you can see here, yeah, that's the that support area there. This chart, I don't have it too cleaned up, but this was one thing that I noted before. You had this bull flag type pattern and a breakout, which I believe a lot pointed out at the time, and I had thought that that breakout would fail, and what it did fail. So like I often say in trading, fewer things are more bullish or bearish than a failed breakout. You know, you have everybody positioned one way, seeing this consolidation and upside break, at least from that downtrend line or this flag type pattern. And so far that's failed. So, you know, in trading, failed bull flag breakout, usually you have a pretty violent reaction to the downside. And so far you can see the, you know, that big red candlestick. And again, divergent high, everything else. It's even showing here on this monthly chart. PPO is poised to make a bearish crossover. Don't underestimate the significance of that. If you go back, replicate on your own chart, especially when you have nice separation between the lines here, like you did back here and right here. Those often lead to downtrends. You know, once you get the bearish crossover. So let's zoom down to the daily chart real quick. Here's that trading range, shaded in white right here. And again, that's anything in between until we break below that trading range or above it is likely to be noise. I do have this uptrend line here that comes off these lows. Almost clips that point. Has a reaction there. We had some reactions there. So that's a near-term breakdown in the dollar that quite likely send it to the bottom of the trading range. And again, here's that negative divergence you can see as we line up here with the, if you follow the vertical line all the way up, you can see the second high with the, in this case on a daily chart, I'm using a MACD and an RSI. So a negative divergence, and again, that helps steer my expectation that more than likely we'll have a downside resolution in this pattern. But again, until we do, trading, at least for the dollar, is likely to be choppy and frustrating. And again, I don't really trade the dollar or currencies. Once in a while I will, but I really watch them for cues on direction in the broad market as well as dollar-sensitive commodities. Okay, let's dig into the charts and try to do this quick, and we'll wrap this one up. Here's the S&P 500. These are resistance areas that we've punched right on through. We've had reactions at each, but right now we're looking at this R3. You know, we have a support shelf right here, this red line. You can see numerous reactions back there. There's a gap if you look closely right here that I'm looking at. So there's where we closed on Friday. We closed just right about on that line, give or take. And you can see that we have downtrend line resistance overhead. So, you know, the bearish case is anything but over at this point. And again, I mentioned this before. This is where I added short exposure. I left dry powder. I'm not adding any more. With with every tick that the market goes higher from this point, it does chip away. It doesn't eliminate the bearish case, but if and when we get above this line and really close above it, that would be I would really start second guessing the bearish scenario. So right now I'm just sort of I'm positioned at short. Have what I have. Don't plan to add unless one or two things unless only one thing happens at this point. I should say I will only add on strength to those positions, which means weakness in the market. I want to see a breakdown, a move lower. Looks like the MACD is getting a little tired here, poised to make a bearish crossover. Here's a bearish crossover right here. Yeah, you can see what happened. And again, those are just certain signals that we use. RSI is quite stretched. Here's the last time we were overbought. You can see what happened if you follow the vertical line up. Last time the RSI became overbought. So really, when you get overbought, you tend to have these corrections that come afterwards, even if there's going to be more upside. Now, this is when a trend was still up. The market had yet to make new highs. These so far are the highs back here on the S&P. So let's look at the 60-minute chart real quick. Try to zoom in. What do we have? We still have, and this is what's, why my outlook hasn't changed. We move higher, but we still have negative divergence. It's not drawn here with another line, but from this point to this point, you can see we've just made another divergent high. Yeah, we've made a few. We had a divergent high here, and then we had a divergent high here. But so far, this is still a divergent high. It's just extended, and I could probably actually modify that trend line or add another one. At the very least, I could put a smaller trend line right here, and might be able. Let's see if we do this here. What this looks like. Yeah, that's pretty clear. So what I would do. And this is not trying to reinforce my case. The charts, I always say the charts are dynamic, not static, meaning they change. This was a trend line. It was valid, I believe. We had a breakdown, a back test. We moved higher. And now we have another trend line here. One reaction, two reactions, three reactions. And this just creates a larger bearish rising wedge. And as I often say, the larger the wedge, the more powerful the move is once that wedge breaks. And so far, this wedge meets all the criteria I like to see. We have negative divergence on a rising wedge. I like to see on falling wedges, I like to see bullish divergence confirming. And like I said, the markets are at resistance, and we've taken out a couple resistance levels, but there's still more to go overhead. So that's that. Let's go to the NASDAQ 100. Same story. We had that bearish rising wedge with the divergent high back here, and now we just have another divergent high. So prices have made another higher high. See, I had that original divergence drawn there. This divergence has been extended, not yet taken out. Let's see what I can draw here. Again, I'm just haven't had time to mock all of these charts up. It's not super well defined because we only have that other reaction, so we might need to see one more. I like to see 3 reactions to really validate a trend line. But with that being said, something to watch. And this would also be a pretty key support level here. This green line, if we fall back on that, watch what happens there. But for now, remember, this to me is the mega resistance area. We had that gap. This was the trading range, and it goes back to the left of this chart. This shaded area was that trading range in late 2015, where especially the NASDAQ 100, the leading index, traded in a very tight, sideways, well-defined range. And like all the other markets and indices in just about all sectors, come January 4th, this was December 31st, last day of the 2015. January 4th was the opening day, first day of the year, and we gapped below that trading range, and the fireworks started. We got a little back test, and that validated that the bottom of that trading range was a well-watched level, and then boom, we had that big sell-off in January. So little retracement, and boom, another low. And so this line here, I should probably make it a different color, but you can see it's around 45, just call it 4,500. In the NASDAQ, or the NASDAQ 100's at 4410. So there's still a little more upside to go. I'm not crazy about how much we've gone up, but let's look at something else. Let's look at retracements. All right, let's go here. What I've done on this chart, these are Fibonacci retracement levels, and hard to make out. I wish I could make these numbers a little bigger, but what you see, what I've done here The yellow line, let's see if I can go to a 2-hour chart. Nope. Okay, what I did is I zoomed out a little to a 2-hour time frame just to show you these were the highs. We had a double top, pretty much a double top high in the NDX, the leading index back in 2015. And so this yellow line just marks those highs. It's slanted down to the lows on the correction. So I'm measuring the Fibonacci retracement levels, and that yellow line right there, just about exactly where we stopped on Friday, is right at that 61.8 fib. And I mentioned this last night in the trading room. I went over all the fibs. You can reference my post last night. And this is one of them. And the theme of that was that just about all the major indices, with a few exceptions, have right now, as of Friday, retraced 61.8% of their original move down off their 2015 highs, which were most of their all-time highs. And I also, what I did here with this blue line, it's really over here, is each of those markets. The NDX was a little different. It really didn't do a whole lot, but in January it had that one last hold up, made another reaction low, and so I did these. I like to use fib clusters at times. So this was, a pretty significant reaction. Not so much on the NDX, but on some other indices as well. And I showed you here, you can see the blue line is a 61.8 fib. So that's really a fib cluster where you take multiple reaction levels and you put up the Fibonacci retracement. So that's resistance as well. Some people trade exclusively off fibs. I just incorporate them into my analysis overall. Let's go back to that SPX chart, S&P 500. This is the whole one strong, the strongest index, and not coincidentally one that I haven't shorted, and I've made that very clear that out of everything out there, I was most bearish on the small caps, the NASDAQ 100. The S&P has too much energy, basic materials, all the things that I'm bullish on right now, and that's why I've stayed away from it. I've seen too many charts in the S&P 500, so that's that. There's a gap right there. That's the big January. What do you call it? The December 31st, January 4th gap. So the kickoff to the party that started in January, that's where we are right now. So that's pretty significant, or a very important resistance level on the SPY, and we closed right about on that on Friday. So let's see what happens from here this week. Let's look at the small caps. Russell 2000. As strong as this advance might seem, here's the highs back on the Russell in December. Really almost a double top high marked by this blue line, Fibonacci retracements. You can see almost perfectly. You can see as I scroll here, there's that Fibonacci level, 61.8. I mean, almost to the penny on Friday. So this is just, so far, nothing more than a typical counter trend rally, assuming, and again, we'll only know in hindsight, but if this is the first leg down, or if this was, I should say, the first leg down in a new bear market, which by just about all metrics I use, nearly all metrics, the longer term charts say it is, then this is just nothing but a normal retracement. I like those retracements. They don't always do this, but they typically fall in this range between the 38.2 fib and the 61.8% fib. Now I had some other lines here. Let's see, there's a 61.8 if you go back a little farther in time. Oops. Yeah, there it is. I had to zoom out to a different time frame, but that was the peak back. See, the Russell topped, and that's something else that really tells me that this market is probably in a new bear market. The small caps, we used to jokingly refer in the industry as small craps. A lot of these smaller names, they peaked way back in early 2015, mid 2015, and have been in a bear market since. They have dropped quite a bit, and you can see that they haven't even retraced. That's the yellow line. That's right where I'm holding my cursor. They haven't even retraced 50% of their initial leg down off the highs. And as I mentioned, this is where the rest of the markets, and especially the leader, the NASDAQ 100, and the SPY peaked a little earlier, but the NASDAQ peaked here, and that was also a significant level because we had that big drop that came after that, and that's the 61.8 fib that we're looking at. So as far as, from Fibonacci retracement levels, this has really all the makings of nothing more so far then a counter trend rally. Now, so far means we keep going up and we keep burning through these fibs, we keep burning through resistance levels. Then yes, then the charts become more and more bullish, but we haven't done so yet. All right, and finally, here's the NASDAQ composite. The NASDAQ 100, as I often state, although it's well followed, you can trade it via the Qs, which is one of the most popular, index tracking ETFs to hold or trade. But here's the NASDAQ composite, which is much more diversified, has many more companies in it. And you can see, looking at the Fibonacci retracements, again, I know it's hard to make out. Well, you can probably see it on the video here. I have two levels, and there's a cluster of Fibonacci retracements. We'll have to go back a little farther to see the first one. That would be from this high. That's when the NASDAQ composite peaked. Interesting to note, well before the NASDAQ 100. And again, I keep harping on that because my theme and everything for, gosh, almost a year now, I've pointed out the breadth, how fewer and fewer stocks were carrying the market highs. In other words, we looked at the ratio of new highs to new lows, stocks trading above or below their 200-day moving averages and some other key moving averages. And everything out there indicated, or you can just pull the charts, that fewer and fewer large cap stocks, mega cap stocks, in other words, the top leaders in the NASDAQ 100 were carrying the market higher. And that is exactly what happened in 2007. And it just shows that the underlying breadth or the health of the market, when you lift up under the hood, isn't healthy. So when you look at the fact, as I said, the S&P 500, the NASDAQ composite, the Russell 2000, the mid caps, they all peaked well before the NASDAQ 100. And that's why I have a lot of focus now on the NASDAQ 100. It's lagging on this move up, which shows those leaders are starting to finally break, and we're not seeing them take this market to new highs. In fact, we've seen a lot of the beat down junk in sectors that have just had the snot beat out of them: gold mining stocks, basic materials, energy, everything I've already mentioned, and that we focused on mostly this year with the trades so far. That's what's gone up. So here's the retracement levels. You can see from the highs back in July, as well as see the double top high here in the NASDAQ composite. That's where I started these fibs. And look at the levels right there. See the two right here? You have the 61/8, both of them in very close proximity. And on Friday, we stopped cold at that lower fib, the 61/8. You have the other fib from the all-time highs just above that. And then you have that key, here's that trading range in late 2015, which really kicked off the party. Once we gapped down, we were well within that range, gap below it, boom, back tested, and there you go. So this, let me just highlight it here to make this very clear. This is a very critical resistance level, and I continue to get questions put to me: has anything changed in my my thought process, my positioning? No, not at all. This is the upper end of where I want to see us go. If we get above here and remain above here, and I'm talking a one-day punch out, even an intraday move. But if we close and we built on those gains for another day or two, I believe I mentioned, this is really like a line in the sand area, is that gap. This is what started the party back here. Let me put a circle on there. This December 31st to January 4th gap. If this sucker gets filled and taken out, then yeah, we're almost there anyways. We might as well make new highs. The market has no business taking that out. It does have, it's possible, very possible, and quite likely now, as close as we are to backtest that level. And again, I don't have, and this is just where I'm already positioned. If I just arrived from a trip around the world today and I didn't have anything, I would be shorting on up to here. But right now, I have enough. I'm comfortable with the shorts that I have. And I would rather add waiting to see a rejection and the market start moving down, some uptrend lines being broken, things like that. Like I mentioned, here's the NASDAQ composite. You have a nice little uptrend line here defining this wedge. If and when that goes, that would be a nice sell signal. So that's that. All right, let me wrap up here. There were some interesting developments in some other sectors, but I'll have to touch on those in a separate video to try to keep this one manageable. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.